In November 2023, one man made a decision that seemed very bold at the time. A user named Sunny Poe decided to take out 8 credit cards at a 0% interest rate. What would he do with this money? Well, some of us buy sofas, some of us buy cars, some of us finance holidays and houses. Sunny Poe decided to put all this money into Bitcoin, all $54,000. Today we're exploring his story. Why did he do this? How has it gone so far? And what is some of the maths behind it? And is this something that is replicable? Is this stupid? And is this something for you? Sonny Poe's strategy was as simple as it was risky, at least on the surface. Using promotional 0% APR offers from major credit cards, including Simplicity from Citi, Wells Fargo Reflect, and Chase Freedom, he accumulated $54,000 in debt to buy 1.4488 Bitcoin at an average price at the time of $37,400 each. Bitcoin trades today in August 2025 at 118,000 US dollars. So the bet has paid off. But this wasn't just a gamble. It was a calculated bet against the fiat currency system itself, and he wanted to use the bank's money to do it. This is how fiat games must be played in America now, Sunny Poo explained on his latest update on X. Either you take what is printed and buy unprintable assets and then wait patiently, or Jerome Powell, Janet Yellen, or anyone will make sure you slave harder for longer as the currency slowly and quickly gets debased. This philosophy may be a little bit foreign to you and may have some words that may be outside of your normal worldview. His philosophy is heavily inspired by a book called The Fiat Standard by Seyfeddin Ammous. In this book, he argues that the system as it currently stands, the dollar has lost 96% of its value since 1913. So taking on debt to buy hard assets like Bitcoin or all other assets isn't just smart, it's a necessity. You will often hear in the media that most rich people do not pay their share of taxes, or in fact avoid taxes altogether. Sonny's bet followed a similar logic. He looked at what the rich people do. What did they do? Well, they store most of their wealth in assets. Think stocks, houses, businesses, gold, and even bonds. All of these typically incur a big capital gains tax when you sell them. So the wealthy figured out a long time ago the best trick in the book is to never sell. Instead of selling, they take out loans to finance their life. By the time the loan is due, they can just get another loan in order to pay this one off. And they do this for their entire life until the day that they die. This is the principle that Sonny is using with his Bitcoin strategy. He could have done the same with any other asset to varying degrees of success. Take the S&P for example. On an annualized basis over the last 50 years, it's generally returned about 10% every single year. The maths is quite simple. If you borrow something at 0% and you buy something at 10%, that difference is going to be your profit margin. Using the S&P 500 as an example, $100,000 would turn into $164,000 over 5 years at a 10% annualized compound interest rate. Debt would only be $100,000, so you're left with $64,000 at the end of all of this, minus any monthly credit card payments that you would have had to make, normally the minimum payment to avoid paying any of this debt back. Coming back to our protagonist, Sonny Poe, after he made this bet, he didn't just disappear, he actually documented the whole journey on X, sharing monthly updates with the numbers, which means we can see that after just 4 months, he was up nearly $47,000, a rate of return of nearly 60%, and then at the end of April, his profits dropped 30%, and that's because Bitcoin is very volatile. But this is a feature and not necessarily a bug, because Bitcoin continued to be volatile to the upside. And as of the time of this video, on the 10th of August 2025, he's currently sitting on $116,000 in profit. All of this has cost him $463 per month. $463 to make $116,000 in profit. Beats working for a living. You can argue that Sonny had very good timing. Bitcoin was trading relatively low in the cycle, and now it's at an all-time high. However, you might be making the same argument 5 years from now. The underlying asset isn't essential to this working, but it makes a big difference, obviously. The most challenging part of doing what Sonny did is the psychology of it all. Most of us aren't good with volatility. If our stocks go up and down a lot, we get a bit nervous. And that's when it's our money, not someone else's. Sonny is using other people's money, and he still has to pay that debt back or roll it into new debt in the future. Do you really think if you were in his situation, you could hold through a 30% drawdown in an asset that you've bought on essentially leverage? The intelligent part about what Sonny did in particular is that no matter the price of Bitcoin, he is not callable on this debt. He will not get a call from the bank saying you have to repay it straight away. The terms are set, and as long as he can repay the minimum payments and he can keep rolling the debt, then he's in a good place. This debt also makes up a relatively small portion, at least originally. I think he said something around 20-30% of his overall net worth. So he would still survive if there was a big downturn. But the bet, especially at 0%, was very asymmetric to start with. I hope you've enjoyed this video. If you do, please subscribe and like the video and share it with all of your friends and family. The purpose of this channel is to focus on weird and wonderful business stories from around the globe and throughout history. I'm a nerd and I want to share that with you. So if you found this interesting, hopefully you'll find the other stories interesting too. See you in the next one.